Welcome back. No one has a crystal ball when it comes to the economy, but we're bringing you the next best thing, the latest economic indicators and what they mean for you. Our expert, Ann McCabe-Triana, is here with 5 indicators you need to know. Ann, thanks for joining us. So I think this is always good for people to get beyond just the basic numbers and understand what's really important in looking at these numbers. And let's start with interest rates. You say when you're trying to look at what's ahead for the markets and the economy, it's the concept of inverting the yield curve that's important in interest rates. Explain that to us.
Sure. So this is when the Federal Reserve decides to increase short-term interest rates higher than long-term interest rates. And the reason this indicator is so important is because if you look back in history, every single recession we've had over the past 50 years in this country has been preceded by the Fed inverting the yield curve. So an incredibly important indicator. And right now, as you can see on the chart that we have up on the screen, the current assessment is we're way in the green. We think that it's going to be 2017 before the Fed would even think about inverting the yield curve based on where interest rates are now and where the Fed expects them to be in the future.
So if you want to talk smart about the economy at that next cocktail party or in assessing your small business, it's not as simple as the bull market ends when the Fed increases interest rates. You got to get a little bit more tricky and impress all of your cohorts with inverting the yield curve. Another number you say is important to look at, the overall index of leading economic indicators. That's the 10 economic indicators that is designed to predict the future path of the economy in a time period between 6 to 12 months. What in that should small businesses be looking at?
Yeah, this is actually my favorite economic indicator because most economic indicators look backwards, but they don't really do a good job of telling you what's meant to happen in the future. The way that this indicator is designed is it's meant to be predictive of what's going to happen in the economy over the next 6 to 12 months. The way it works and what you should pay attention to is when the year-over-year index drops and starts going negative, that is a red flag, and it typically means historically that we'll have a recession in anywhere from 0 to 14 months. Right now that indicator is also in the green. Breaking news, we got this number on Thursday, and it was up 0.8%, exactly as analysts expected. So another
we're okay
green
on
indicator.
that. So yeah, not to worry as much. Stock valuations. There are specific numbers. Again, looking at history, looking at this from pure numbers, there are some specific numbers you can look at when you're talking about the price to earnings ratio. What are they?
So over the past long term, I should say, from 1927, the average PE ratio on the S&P 500 index, which is the main index that we track here in the U.S., is 15. So long-term average is 15. As of Friday, we're at about 18.7 in terms of PE ratios. So we're on the high side. This is the one indicator of the 5 that is a tiny bit alarming. However, I think it's important when we're talking about valuations to talk about them in the context of comparing them, stocks specifically, to other asset classes. And right now, investors are so limited in terms of what they can do with a dollar that they want to invest. Cash is not paying you anything. 10-year Treasury is paying you 2.2%. So comparatively speaking, I'm not so concerned about valuations, but they are on the high side.
Okay, market breadth. Now this is how many companies are actually participating in the strength of the rally. If fewer companies are participating in the rally, you can be more vulnerable to decline. Where are we on market breadth right now?
Exactly. Bottom line is the rally has been very broad-based. So lots of different companies, lots of different sectors participating in this rally. So that's not a concern at all right now.
And then finally, the Institute for Supply Management's Purchasing Managers Index.
It's a mouthful.
A mouthful to say, and what does it mean in terms of what you need to look for?
So this is a survey that they do every month, and they call purchasers. So these are people responsible for making buying decisions, typically in the manufacturing industry, I should say. And only about 40% of S&P 500 companies are related to manufacturing. But what we found historically is when the ISM number peaks, usually earnings will peak about 6 months later. So this is a great leading indicator as well. That was released at the beginning of the month. For the 16th month, it's been positive, so also in the green.
Overall, you say, barring some major unexpected blow to the economy, we're probably in mid to late cycle of this recovery. You say the market has more room to go up, but volatility you think is here to stay for.
I do. Long time without volatility, and I think it's back. So, for long-term investors, if you have cash on the sidelines, I think it makes sense to put that to work if you can stomach the volatility.
That's such good advice. Thanks for joining us on Washington Business Report.
Sure.
Well, stay tuned. The Roundtable is coming up next.
on.